Hi, I'm Ben Reppond. Today is November 8th, 2022. Welcome to my YouTube broadcast. This week, on Thursday, the CPI, Consumer Price Index, will be announced. It's the rate of change, the inflation rate, annualized 1 year over the other. And when you look, and it's a national number, when you look at the rate of inflation for us as a nation, and you break that down into its individual parts, whether by city, region, state, there are differences. Sometimes there are wide differences. I saw an article, actually a YouTube video, that showed that there are cities that have twice as much inflation as other cities, a 2-to-1 ratio. And so I thought I would show that to you, showing how different some cities are compared to other cities. The high inflation cities versus the low inflation cities. This is a CNBC piece. Take a listen.
Americans moved around a lot over the past 2 years.
Many have generally gone either south or west.
And those destinations also happen to have the highest inflation rates in the U.S.
The story of inflation is more a story about hotbed migration destinations and how that changed during the pandemic.
Phoenix, Atlanta, and Tampa are among the metro regions seeing both hot inflation and the pandemic surge of home buying.
The reason why Atlanta is one of the hotspots in terms of inflation in the country is because people are moving into Atlanta.
2 or 3 times a week, we get phone calls, people wanting to buy our house for cash, complete strangers.
We saw right away that inflation was highest in Phoenix and lowest in San Francisco.
Nationally, the Consumer Price Index rose by 8.3% in April 2022.
They're effectively becoming poorer as prices rise.
Now, once people get here and find, wow, this inflation is so high compared to where they moved from.
It's important as ever to pay attention to how migration is impacting things like inflation.
Here's where inflation is burning red hot and how migration across the country affected it. Many Americans relocated from expensive coastal cities to more affordable urban areas, according to the real estate broker Redfin. However, this kind of inflation migration trend seems new.
2021, where we started to see an acceleration of migration driven by the pandemic into these hot places like Tampa and Phoenix and Atlanta, where we really started to see the relationship expand and pull out, where the hot migration destinations are driving the big increases in inflation.
According to Redfin's analysis, Phoenix has the highest inflation rate of any U.S. metro area. Prices spiked 10.9% in the first quarter of 2022. Plus, Phoenix was one of the most popular places to move to, second only to beachy Miami, Florida, according to Redfin.
Housing is definitely a large component that is driving that. Housing costs in Phoenix as of the first quarter are about 12% growth right now.
Most people in Phoenix that are homeowners are watching the home price inflation with a great deal of enjoyment. Essentially, home prices are darn near doubled what they were 2 or 3 years ago.
Hot housing market like Atlanta's.
We have a lot of people moving in. That's definitely increased the demand for goods and services, and especially housing.
Redfin said Atlanta had the second highest inflation rate at 10.6%. And the Georgia metropolis also happened to be the 10th most popular migration destination.
People have more work flexibility, and they are also looking for more affordable places compared to San Francisco, New York, and all the other bigger metropolitan area. Atlanta is still much more affordable. That margin is definitely shrinking.
The Sun Belt trend continues, with Tampa, Florida having the third highest inflation rate at 9.9%, and as being the third most popular migration destination. Meanwhile, the city that saw the most people moving away was San Francisco, and San Francisco had the lowest inflation rate in Redfin's analysis at 5.2%.
We know a lot of people that we've been tracking throughout the pandemic have been leaving places like the Bay Area and been moving and pouring into these hot migration destinations throughout the pandemic.
The New York City area had the second lowest inflation rate at 5.4% and saw the third most migration away.
And keep in mind, this is price change, not price level. So we're not saying it's less expensive to live in New York. It's just that their current inflation rate's a little bit lower.
The year 2022 has been a year of decline for the stock market and the bond market. In the stock market, what has had the greatest rate of decline has been the tech stocks, or the NASDAQ, or the NASDAQ 100. And they are down in total about 30 to 35%, and much more than the rest of the stock market. Some people think that tech stocks are so overbought that they are a bargain and people are starting to buy them. However, it's interesting that this week I saw an article that showed that Facebook has lost 800 billion of its value. Mr. Zuckerberg has lost about 100 billion of his money. He had 138 billion at one point. Now he's down to a mere 38 billion. It's lost 73% of its value. About a year and a half or so ago, year and a half ago, Facebook was probably the number one, or in the top 5 for sure, probably number one growth or value company in the S&P 500. It was ahead of, or nearly ahead of, every stock inside the S&P 500 index. Today, having lost 73% of its value, $800 billion, it is now ranked dead last. 499 companies are valued higher in the S&P 500 index, are valued higher than Facebook. Scott Wapner from CNBC interviews Gunjan Banerjee, and I'll let you take a listen to this brief piece.
You've been writing a lot recently about the future of the tech trade. Mega cap tech's had a terrible week. Where do you think it's going from here? Are we at the cusp of a real change from these stocks, which were the ones that everybody piled into in good times and frankly bad, right? They were viewed in many respects as safety trades, defensive plays. Where does it go from here?
I mean, that whole idea of tech being the defensive trade has completely sputtered. And we've seen the kings and queens of the stock market dethroned. I think the shocking thing for me when I speak with investors is, I ask them, look, Meta is off $800 billion in market valuation. Is it a value now? There's no resounding yes there. I have investors telling me, I still don't think this company that's down 50, 60% is a value, which is pretty shocking. And that's bad news for the tech trade moving forward.
Because these valuations have come down a lot from where they were, and you still have, to your point, some suggesting they're still too expensive, many of these names.
Totally. And, their spending, it still seems out of hand to a lot of investors. Think about Meta. Zuckerberg was pressed on CapEx, topping $30 billion next year. He said investors who stick with our shares will be rewarded, who are patient will be rewarded. The next day, the stock fell 25%. So that tells you where investors' minds are at right now.
Yeah, it's been a really tough week for most, not Apple. It's hung in there. It's great to see you. Welcome to our show.
Thank you.
And we'll see you soon. That's Gunjan Banerjee joining us again from the Wall Street Journal. Hope everybody has a great weekend, because we got to buckle up for next week as well.
Inflation is high and going higher. I want to show you a piece from CNBC. Tyler Matheson interviews Dr. Frederic Mishkin, and Dr. Mishkin is a professor of economics at Columbia University, has his PhD in economics from MIT, and was former Fed governor from 2006 to 2008. It's interesting, when he resigned his position in 2008, that Jerome Powell was the one who was elected to fill his position, who later became the chairman of the Federal Reserve. But I want you to listen to this piece as Tyler Matheson interviews Dr. Mishkin on the question of inflation, the counter by interest rates, and the effect on the economy from Dr. Mishkin's perspective.
Let's bring in now former Federal Reserve Board Governor Frederic Mishkin. He's also a CNBC contributor. He's a professor. He's a lot of things. Frederic Mishkin, welcome. In my notes, it says, given this, you say, it is premature for there to be any talk of slowing the pace of rate hikes because that will weaken the Fed's credibility that it will do what is necessary to contain inflation. You've listened to a lot of discussion here. You have read and seen what the Fed has said. Have they fallen into the trap that you outlined in your note?
Not yet, but I do worry that that it's premature to talk about slowing down increases in interest rates. Realize that we're still at very low interest rates relative to inflation, and that's the key. That in order to deal, and also that the Fed got behind the curve up until recently. I have to tell you, I think they performed extremely well in terms of really turning 180 degrees. They made huge, I think, very major mistakes, which I've been talking about for almost a year and a half, but they now have got their act together. The problem here is that when you look historically and you look at cases where inflation gets out of control, the central bank or the Federal Reserve gets behind the curve, you've got to raise rates, and these are real interest rates, the interest rates adjusted for inflation, to levels which are at least 2-3%, and sometimes you have to even hit the economy much harder with the baseball bat, which is what Volcker had to do. So we're in a situation where any projections of what we think inflation will be over the next couple of years is certainly above 3%. Maybe we'll get lucky. And so this is telling us that the Fed needs to get at least to 5%, and I think even higher than that. And indeed, because they got behind the curve, they've got to show that they're really serious about getting inflation under control. And if they don't do it, they'll have to raise rates by even more, which would make things even worse.
So let me go back to what my notes say you said to us, and that is that it would be wrong to do any, quote, talk of slowing the pace of interest rate rises. And it seems like you're saying they didn't say that. They didn't fall into that trap.
No.
So what is it that they did say in saying we are cognizant of the fact that there are cumulative effects of what we've already done, and that there will be lagging effects from what we will be doing?
So this is actually what you should always do. Okay, so the monetary policy has long lags. I do worry a little bit that there are some more voices, and you sometimes hear them from the Fed, about some concerns about whether they could go too far. I just think that it's premature to do that now. That should they worry about this? Absolutely, they should. But we've seen absolutely no evidence that inflation is particularly inflation, which is taking out some of these volatile elements like food and energy, is contained and is moving back to 2%. No evidence of that. And the Fed did get behind the curve. They've got to correct for that. I think actually they're very striking and extraordinary moves. These are the largest meeting rate increases that we've seen since the Fed started targeting the federal funds rate. So there were larger increases during the Volcker era, but that was not a period where the Fed actually said it had a target for the federal funds rate. So that's extraordinary, but they have to keep on doing it to basically make sure that people realize that no matter what, they're not going to let inflation get spin out of control. Because if they do, they'll have the mistake that Volcker made in 1980 when the Fed backed off. And the markets then it took a lot more. They had to really kill the markets. They backed off, they lowered interest rates, and then they had to raise them another 1,000 bips, another 10 percentage points in order to get where they were. And that really killed the economy. So that was the worst recession in the post-war era.
Inflation is stubbornly high. Jonathan Farrow interviews Dr. Mohamed El-Erian and on the question of inflation and interest rates. Dr. El-Erian says the interest rates are high, but they need to even be higher. They need to keep on, the Fed needs to keep on being aggressive with rate hikes. Take a listen to this.
Is it too early to prep the groundwork to wind down this hiking cycle?
Is it too early? In my opinion, yes. I think that inflation is more problematic than what a downshift now would imply. Having said that, if I was sitting at the Fed right now, I would really struggle, John, in terms of where I would end up, because the market has run away once again with, at least you're calling it a step down and downshift. Most people call it a pivot, which has loosened financial conditions significantly. So it's a tough one for the Fed. This is a really, really tough meeting.
How does that get addressed, do you think, in this news conference today, Mohamed?
He has to be really delicate, John. He's trying to optimize across 3 dimensions, all of which speak to his dual mandate. And it's not easy because the marketplace just wants to hear one thing. And the marketplace doesn't recognize that there are these 3 dimensions and that you've got to optimize, and it's tricky and you can't pre-commit too early. So it's going to be really, really tricky.
There is a contradiction with the economy and jobs. The economy is struggling, and it is clearly predicted that the economy is going to crash. However, in contrast to that, jobs are strong and unemployment is low. It's an interesting time that we live in. How can that happen? How can jobs be so, people are fully employed? If you want to work, you can get a job, and yet the economy is struggling. An interesting paradox. So David Weston interviews Dr. Larry Summers from Harvard, and he points out that there is no recession yet, and that jobs are strong, and that the Fed needs to keep on hiking rates and to be aggressive. We've been hearing this. And he feels, this is the first time I've heard this, he feels that interest rates will have to go to 6% or more. I remember when they were talking about 3% and 4%, then you started to hear 5%. Now Larry Summers is talking 6% or more. Take a listen.
Let's start with the jobs numbers, because they came in, I think, at least relatively strong. How did you interpret them?
I saw it the same way. Look, the population only grows by about 50,000 adults a month. So anytime you have 250,000 jobs, you're growing at a rate that you're not going to be ultimately able to sustain. It shows that still the economy is looking quite strong, no recession soon. You saw wages tick up. So the good news is economy looking robust. The bad news is not much evidence of inflation restraint yet in train.
Of course, when Jay Powell, the chairman of the Federal Reserve, spoke earlier on Wednesday, he didn't know what those jobs numbers would be, I don't believe. At the same time, what he said anticipated just what you just said, is that inflation continues, they're going to have to keep hiking. I assume you thought what they did made sense.
Yeah, I think there was a little bit of bouncing around immediately after the statement. But after Chairman Powell's press conference, I thought the necessary and right signal has been sent that the Fed is determined to stay the course with respect to inflation, that a sensible judgment of where the terminal rate, how high Fed funds will ultimately have to go, has gone up given the strong inflation numbers, the strong employment numbers that we've seen, and that the Fed is determined. So I thought those were very much the right kind of signals for the Fed to send, and I think it's appropriate. I think we are starting to get some little suggestion in the data. We don't know yet, and we always have to remember about lags, that the effect of interest rates on slowing the economy might in toto be somewhat less than many people supposed. And if that's right, I think it's going to be pressure for interest rates to be pushed up further in order to get done the necessary inflation restriction. So I'm moving upwards my view on the possibilities for the terminal rate. It's not what I would expect, but it would not surprise me if the terminal rate reached 6 or more. And I think the Fed has to be noticing that there's been started to be some upwards moves in inflation expectations, albeit from low levels. And that's got to be a source of concern for them as well. Nothing in this data to support the concerns of those who believe the Fed is overdoing it. A bit in this data to support the idea that the Fed's really got to be very determined to stay the course.
And finally, I want to show a clip from Kathie Wood, the CEO of the ARK funds, ARK Innovation Funds. And she has an interesting perspective on inflation. And yes, she acknowledges that we have high inflation. There will be interest rates that are going to be, they're going to continue to raise interest rates to bring inflation down. But she's looking beyond that, looking at what happens after that. She says, she theorizes that we will go from inflation to deflation. And you may think this is not a term that we've heard very much because it has not been around. We've talked about, inflation and recession, but deflation, that hasn't been around for a long, long time. Let me just translate this for you. What deflation is, that means a crashed stock market, in this case, probably a crashed bond market. Housing prices are falling, jobs are lost, and the economy is in shambles. Asset prices are cheap. That's what deflation means. So it's not a pretty picture. But she calls it good deflation. There's good deflation. Well, what can that be? So she sees that when this happens, it's an opportunity for innovation companies like ARK funds, innovation company, or the companies represented by ARK funds, the opportunity for innovation to take place. She goes all the way back, not just to the 70s, she goes back to the teens. Following World War I, 1918, 19, 20, and 21, where there was deflation. And what happened? New platforms, technology platforms emerged. What were they? The telephone, electricity, and the automobile all emerged in the late teens. And she sees that that is what is on the other side of inflation. Yes, there will be deflation, but she takes the positive view and says it will be the opportunity for these new innovation technologies to be introduced. Take a listen to Kathie Wood.
I know you don't need to be reminded of this, but for viewers, obviously, and context is important. So that 120% upside that you saw for the central fund within ARK, of course, between 2020 and 2021, and now, of course, year to date, the flagship fund down about 60%. What are the lessons learned then from you and the team from that kind of drop that we've seen?
So it started actually in February of 21. We started declining. Truly disruptive innovation started declining in February of 21, while the market soared to all-time highs in 21, and now the rest of the market is suffering as well. So vaccine, people going back to work, supply shock. The businesses had shut down, wondering if they would ever reopen their doors, right? They shut down. At the same time, governments around the world were stimulating aggressively. So we had a supply shock, especially because demand actually was so much stronger than anyone expected. And I would say lessons learned, could I have dreamed, a technology investor, that supply chain issues would have lasted more than 2 years? No, I never thought that for a second. I thought we would be over that in a year, and certainly couldn't have predicted Russia's invasion of Ukraine. So the question is this a 70s style inflation, which is how the markets are treating it right now, and why our strategy has been decimated, and most growth strategies have been hurt very hard. We don't think it is. I think the market's pricing is pricing innovation as though we have a bad inflation problem that's going to take interest rates up even higher. We don't think so. We think actually the greater risk and opportunity is deflation. I think we're going to start seeing deflation on a month-to-month basis. We're already seeing commodity prices come down. They've broken down, many of them. That's upstream, at the top of the pipeline. At the bottom of the pipeline, around the world, we're seeing a massive inventory overhang as we're heading into the holiday season. How will they clear that? Discounts. So I think cyclically, we're going to see deflation. We're already seeing it in the pipeline. Secularly, we will also see deflation. We spend all of our research time focused on disruptive innovation, technologically enabled disruptive innovation that is inherently deflationary, but that's good deflation because as prices for electric vehicles continue to come down, we will see a continued boom in electric vehicles. It will hurt the internal combustion engine cars, but it will help the innovators. So I think we're going into a deflationary period, much like the late 19 teens. So 1918, World War I ended. Spanish flu also hit. So think about that. War, flu, very similar dynamic, right? And the other similar dynamic was three major innovation platforms that were going to transform the world: telephone, electricity, and automobile. They were all scaling exponentially and took us into the roaring 20s. So supply shocks took inflation back then to 15%, but within a year and a half, 2 years, that inflation started dropping and it ended down. I'm sorry, the inflation was 20%. It ended down, deflation, 15%, roaring 20s. I'd like to think that's what we're going into now, and there's a high probability we are.
I want to present interest rates on bonds or yields on bonds. And as interest rates have been going up, bond yields have been going up. But what's been interesting, a lot of people are watching this, there are different durations in bonds. I'm going to show you the contrast between the 2-year and the 10-year, the ratio, and then we'll take a look at one that's not a ratio. But they are all very high. This chart shows that the yield on the 2-year government bond and the shorter duration, like a 2-year, the shorter duration, usually the lower the yield. However, what's happened this year is that the yield is higher in the 2-year than the 10 and the 20. So this shows, look at the yield on this bond. It's just going sky high because people want a place for their money and they don't want to tie it up long term because they don't trust that rates are not going to go even higher. That would be my theory. So, but there's where it is today, and that's where it's come from. Now take a look. This contrast, the 10-year government bond, the spread on the 10-year government bond and the 2-year government bond. If it goes down, this means that the 2-year yield is higher than the 10-year yield, and vice versa. So what I did was circle in red, going back, this goes back to the 1980s, early 1980s, you can see the 4 times where the ratio of the 10-year to the 2-year fell below 0 when that ratio actually became negative. And then on the far right, you can see where we are today. What usually happens when the yield, that ratio, goes negative, it is followed by a recession and usually a crashed stock market. It's probably the primary indicator for a recession. So you can see, going all the way back to the early 80s, you can see the pattern and the predictability, the validity of this as a predictor of a coming recession. So I just want to see that's where we are now. What can you do about it? The first thing you can do is just know about it. Know that that's what's in our future. A lot of people are talking about the idea that 2023 is not going to be a very good year. Well, 2022 has not been a very good year, but it has not this year. The economy has not crashed. The stock market has not crashed. The bond market has not crashed. What has happened is they have been gradually declining and eroding and sliding into the ocean, so to speak, just gradually going down, down, down. Any attempt to go back up, it goes back down. So that's this year. So for the market to go back up, we need to have a crash, a capitulation. I'm not advocating for that because I want the market to go up. But realistically, I think we are probably, is it 2023? I don't want to predict that for sure, but I would say somewhere in our future, this chart is an indicator that we probably have a recession, a crashed stock market, and likely a crashed bond market. More so than just a market that's in decline. I want to give you the flow of funds report. This shows that money has been going out of equity funds and bond funds, and money has been going into money market funds. So equity funds lost 11.6 billion, bond funds lost 13.5. Looks like mostly sellers, more sellers than buyers. And then that money, some of that money has been going into money market funds, gain of 4.6 billion. The Fed and the Fed up. Thank you for watching. If you have questions or comments, feel free to leave them in the comment section below and I will try to respond to them. Every week I do this broadcast, and usually in the room with me is my dog. His name is Shep. He's an Anatolian Shepherd, so his name is Shep. And so I thought I'd introduce you to Shep. Take a look at him. He's a very big dog. But anyway, he accompanies me each week. Thank you.